All right, let's get into it. Today, we're basically financial detectives, and we're tackling a really weird case. It's a story packed with conflicting clues, some hidden signals, and a stock that, well, it seems to be telling two completely different stories at the exact same time. So the big question we're trying to crack is this. Is this stock just a risky trap waiting to spring on investors? Or is it maybe a hidden opportunity, a diamond in the rough that nobody spotted yet? That's what we're going to try to figure out. So, who's our subject? It's a company called Republic Power Group, and its ticker is RPGL. Now, on the surface, it looks like just another company in the energy space. But trust me, once we dig into its chart, you'll see it's full of these fascinating contradictions that make it the perfect case for us to break down. Okay, let's open up the case file. RPGL is in the renewable energy sector. It's what we call a small cap stock, which basically means it's a smaller company, and that almost always comes with more risk. The key thing to notice here is its high price fluctuation. This thing swings up and down a lot, and right now it's trading for just over 68 cents. So those are the basic facts. Now let's go hunt for some clues. Every good investigation has to start with the main piece of evidence. And for a stock, that's its price trend. We're going to follow the trail left behind by its moving averages to see where this stock has been and maybe, just maybe, where it's headed next. So what are moving averages anyway? Just think of them as a tool that helps us see the bigger picture. They kind of smooth out all that messy day-to-day market noise so we can see the real underlying direction of the trend. It's a little bit like looking in your car's rearview mirror. It shows you the road you've just been on, which helps you guess what might be coming up ahead. And boom, this is where our case gets really interesting. When we look at the short-term clues, the 5-day and 10-day averages, everything looks pretty good. The price is above them, which suggests there's been a recent burst of positive energy. But then, when we zoom out and look at the long-term clues, the 20 and 50-day averages, whoa, the story completely flips on its head. The price is way below them, pointing to a really strong, long-lasting downtrend. And this line just sums it up perfectly. The stock is in a full-on short-term sprint, trying to gain ground, but it's running straight into this massive, long-term headwind that's just trying to push it right back down. This is the first major contradiction we've got to solve. So to get a better handle on this whole conflict, we need to try and read the market's mood. Is it feeling fearful? Is it feeling greedy? We're going to pull out some tools that help us measure the energy and emotion, the volatility and the momentum that's driving these price moves. Okay, our first tool for this job is called Bollinger Bands. They basically draw a channel around the stock's price. When that channel gets really wide, it's telling us the stock is super volatile. It's kind of like you're driving on a really bumpy road with a ton of sudden jolts up and down. And for RPGL, believe me, the bands are pretty wide. Now look at this number, 102.54. This is the key piece of evidence we're getting from the Bollinger Bands, but, what does that actually mean? So that number means the price has stretched so far, so fast, that it's actually punched outside the top of its normal trading range. This is a classic signal that a stock might be overbought. Think of it like a rubber band that's been stretched way, way too far. It's probably going to snap back. So this clue suggests that recent sprint might be running out of gas. All right, next tool in the kit, the Relative Strength Index, or RSI. It's a really simple momentum gauge. It just runs on a scale from 0 to 100. If you get a reading over 70, that suggests a stock is overbought, maybe a little too hot. And if it's under 30, it suggests it's oversold, or maybe too cold. And here's what the RSI is telling us about RPGL. The short-term 14-day RSI is sitting around 47, which is, right in the middle, totally neutral. But if we look out over slightly longer periods, like 21 and 28 days, you can see the RSI is way lower. It's getting really close to that oversold level of 30. And that suggests that right before this recent little sprint, the stock had been beaten down pretty badly. So what's the verdict from this piece of evidence? It seems like the stock is in a bit of a Goldilocks zone. Not too hot, not too cold. It's not really overbought, but it's not super oversold either. This adds another layer of complexity to our case, suggesting the stock has cooled off from its lows, but it hasn't exactly overheated yet. Okay, our last momentum tool is the MACD. Now, this one sounds a bit complicated, but its job is actually really simple. It tries to spot if a trend is gaining or losing steam and might be about to change direction. It's kind of like a weather vane for the market's momentum. And the MACD is giving us a subtle but pretty important clue. Its histogram, which is what measures momentum, has just ticked over into positive territory. So here's the key takeaway. Even though the long-term trend is pointing down, This indicator is hinting that the downward momentum is fading away. The selling pressure is letting up, and it looks like the buyers might, just might, be starting to show up. All right, we've gathered all our evidence. We've looked at the price trends. We've tried to read the market's mood. Now it's time. Let's put all these clues together and deliver the final verdict on the case of RPGL. Okay, here's all the evidence laid out side by side. In the bullish corner, you've got that positive short-term momentum, you've got indicators that are near oversold levels, suggesting it could be undervalued, and you have the MACD hinting at an upward shift. But in the bearish corner, you have that powerful long-term downtrend, you've got high volatility, which just means high risk, and you have that immediate signal that the price might be overbought. It is a true tug of war. So, after all that, what's the final verdict from the sources analysis? Well, it gives the stock a technical score of 6 out of 10. That's kind of neutral, maybe leaning just slightly positive. The evidence for a potential turnaround just barely outweighs the reasons to be careful. This is definitely not a slam dunk case. So we've solved the case, but what does all this actually mean in the real world? Here's the final takeaway from the analysis and what it could mean for you. The final tip is this. Because of all that volatility and that really strong long-term downtrend, the source concludes this is not a stock for a buy and hold strategy. It's more of a high-risk, high-reward situation, probably best for a speculative, quick trade, if you're comfortable with that kind of risk. And if you were to even think about it, the source gives a very clear 3-step approach. 1. Know what you're getting into. This is a short-term gamble. 2. Manage your risk. The source suggests setting a stop-loss order around 40 cents to protect yourself if that downtrend kicks back in. And 3, and this is always, always crucial, look beyond the chart. Technical clues are only one part of the story. You always have to check the actual news about the company itself. And that brings our investigation to a close. We've seen how one single stock can be this fascinating puzzle of conflicting signals. So that leads to my final question for you. With all this evidence on the table, how do you weigh the clues in a messy, contradictory case like this one? Which signals would matter most to you? Thanks for joining us for this explainer.